with this week's edition of Freedom Flash, some timely insights about today's market. Today is Wednesday, February 23rd. Yesterday, Tuesday, the 22nd. The S&P 500 is actually now this year down a little over 10%. In our investment world, that's normally referred to as an official market correction. And so I'm sure a question on everybody's minds is that unusual? Should we be worried about that? So what are your thoughts just on admitted retreat in the market so far this year?
Well, certainly people are, seeing their investment accounts values drop and they get a little concerned. Lots of headlines out there in regards to inflation and Russia, Ukraine. So it's definitely understandable for them to see this pullback and say, is this the start of something more serious? I would say a lot of what's driven is all a combination of all those factors. It's again higher than expected inflation, a little bit more aggressive tightening on the Federal Reserve part, but a lot is driven by Russia and Ukraine crisis that's happening right now.
If we dig into that a little bit, let's maybe try and put that in perspective in two respects. So one is, how important in the long run is Russia to the world economy? What's the U.S. exposure to Russia? And then maybe a bigger question, historically, what has been the market reaction to geopolitical flare-ups like this? How long lasting are they? How does the market tend to process those?
Certainly there's a lot bigger geopolitical, certain consequences from what potentially could unfold, but a lot of those geopolitical, aspects of it aren't too much economically driven, at least specifically to us here in the US. Europe has a little bit more dependency on revenue and energy from Russia, but more specifically, when we see flare-ups and geopolitical issues, markets do sell off. It's just kind of you don't know how far into a war or what could potentially happen. So markets have historically sold off 5 to 8%. And like we said, we're just down 10% from right now. So that's certainly could be induced a big part of this recent sell-off, but that's usually about all, especially when we look at the actual implications to our US economies in the company's earnings. There's not that big of a hit that could potentially even happen in the worst case scenario. So we see about a 5 to 8% sell off, and then the market's usually within a few weeks, usually takes maybe a month or two, and they've historically recouped their previous highs once one of these types of geopolitical issues have surfaced before.
Maybe we should also just put corrections as a market event in perspective. And I think it's true that historically a 10% correction, although not fun to live through for any investor who has significant dollars in the equity markets, it's actually not that unusual. And I suppose hearkening back to a video we did recently about cash, if you have some cash, it's probably an opportune time to put some money to work.
You're exactly right. Investors have been sort of lulled of a low volatility market since 2020 and the COVID crisis. We haven't had but maybe 1 or 2 5% pullbacks. So historically, the markets have at least a 10% pullback once a year. So this is nothing new. It's something that we just haven't seen recently, but historically, we have at least a 10% correction once a year. And again, no one knows exactly when the bottom's going to be, but we would definitely say now, looking at, all the expectations from the US consumer, the earnings that should be coming out, now would actually be a pretty attractive time to take advantage of this 10% pullback.
I think with all that as background, maybe that pivots us back to what may be the central thing going on here. And maybe you just have a few closing comments on, in light of what's going on with interest rates, Fed activity, what's our current view on the market for the next 1 to 2 years?
To say it in a synopsis, we're still definitely bullish on the US economy. Right, there are concerns, and again, barring potential, issues with the Russia-Ukraine, the biggest concern is inflation, of course, and how significant it's going to take how much time is it going to take for the supply chains and things like that to return to normal? Ultimately, though, the demand is there. We've seen high inflation this entire past year, and the consumer it hasn't outpriced consumers. Consumers still can afford to spend and have that demand to do so. So ultimately, again, we look at this pullback as an opportune time. Some of the valuations that we saw over the previous years have corrected themselves to more appropriate levels in this type of new environment where it could be a little bit slower growth, but still significant economic consumer consumption and demand to drive revenues higher. And we expect that, going forward the next 1 or 2 years, we should still be in that sort of mid-cycle economic expansion where you don't want to miss out. You want to still be exposed to it and then start to reassess when we get to the later cycle how you want to rebalance your portfolio.
So terrific. So folks, that's our Freedom Flash for this week. As always, if you have any further questions or there's anything that we can help you with in terms of your own personal investments, please reach out to us. But thank you very much for listening. Thank you, Kyle, for your insight.